Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, March 28th, 2018. I wanted to go over a handful of charts here, some things that I've covered in the past but haven't touched on in a while, sort of an eclectic mix. I'll paint out the bigger picture and really, if time permitting, go into my strategy for, going forward, how I plan to trade this market, both as an active trader and an investor, going forward. So we're starting out here looking at one of my favorite charts, the Nasdaq Advanced Declining Issues. So up top, this line represents the number of issues within the Nasdaq Composite that are advancing versus those that are declining. So when this line is going down, that means you have more stocks within the Nasdaq Composite falling than you have rising. And normally, one would think in a bear market, that's typically the case. You're going to have more stocks falling than rising. And one would think logically in a bull market, you should have more stocks going up than you have going down. That is often the case, but not always the case. And where I find value in this, predictive value in this, is like everything else. You guys know my buzzword, divergences. Now, why is it? Is it just because I can draw these divergence lines that mean you're going to get a correction? No, there's logic behind it, and it's simply this: that the signature of end of a bull market is to see fewer and fewer stocks, the beloved names, those overowned, overloved names. Right now, think FANG stocks, FAME, FAAMG. That's a term I dubbed a few years back. The big buzzword was FANG, FANG. Either way, these are market-leading stocks: Facebook, Apple, Amazon, Microsoft, Alphabet. They make up the bulk of the returns of the NASDAQ 100, or a good percentage of them, because it's a very overweighted index. In fact, even the S&P 500 is not an equal weighted index. The bigger names, Apple's the largest component, therefore whatever Apple does has the biggest impact as far as any other stock on the index. And that is why you can have this type of divergence. That is why you can have the market rising as you did. This is a 20-something year chart. So you can see going back into the dot-com bubble, which peaked in March of 2000. The stock market was going nearly parabolic while we had clear divergence. The number of advancing versus declining issues was clearly falling, showing fewer and fewer stocks were doing the heavy lifting. And as is almost always the case, that resulted in a vicious bear market that wiped out all those gains and then some. You can see that. Um, then, as you can see, when the markets were in a bear market, where the Nasdaq was falling here, so was NAD line. The market bottomed here back in mid 2002, and you can see very healthy price action because you had a lot more stocks. The AD line, or the NAAD line, was going up and along with the markets. However, from that point you started to diverge, and there are corrections to be found. You had minor divergences within here. You had a divergent high here, divergent high here, and each of those did result in corrections. Um, but it was an extension really of one big divergence. And the point that I'm trying to make here is we're looking now, and you can go back decades, and we're looking back into the 80s, the 90s here, and you can go even farther back in time, and you will see that at no other point in time other than leading up to the market top in 2007, which again was followed by over a 50% drop in the markets, leading up to the 2000 top, the tech bubble back then. The only divergences that are comparable to the ones that we have in place right now were those. We had some small divergences back here in 2011 through about almost 2013, late 2012, and they did result in corrections. You had some pretty decent corrections. Again, it's a big chart. It doesn't look like much, but it was a pretty significant correction. And then you had this divergence here, which was pretty significant, spanned for about a year and a half, and that was followed by not just the largest correction in this entire bull market. The S&P, in fact, barely missed the designation of a bear market. It almost fell 20%. The small caps, mid caps, and I think possibly the Nasdaq Composite did hit that 20% bear market threshold. So technically, within some indices, this was a bear market within a larger bull market, and most importantly, it was preceded by the divergence, clear divergence in the NAAD. So again, the takeaway from this is Uh, whether the top is already in or whether the top is 2 months or 2 years away from now, I suspect it's somewhere in between, anywhere from we're already there, or it will be within the next, my guess is the next few months, 6 months at most. Um, but this tells us be in store for not just a correction, not just another buy the dip, get long stock market correction. If history repeats itself, this shows us that this market is not healthy. This last advance, it was not quite parabolic, but near vertical ramp, similar to what we had in 2000, even more so than what we had leading up to the 2007 highs. And again, my expectation isn't for a meltdown type scenario like we had here or here, although anything's possible, and I'll be on the lookout. I'll take the charts as they come, but I think we're going to work our way down over time, and it'll probably be a prolonged bear market, one of the longer bear markets in recent history, probably lasting more than a couple of years. This one I think was about 18 months or less. Peaked in October of 2007, bottom in March 6, 2009. All right, let's move on to the next chart. This one I posted in the trading room today, and I've posted it on the site before. This comes off a site called advisorperspectives.com. You can check out the post in the trading room or go directly to their site. And what they do is they'll every now and then they'll update margin debt versus the S&P 500. Now, margin debt, for those of you not familiar, if you open an account at a brokerage firm, you can have a margin account where they'll let you borrow against the value of your securities. So you put 100,000, you can buy 300,000 more, of stock. Depends what how much margin they'll give you. In fact, you can even leverage up by futures accounts where you can expose yourself by buying, e-minis and other futures, 20 times or more leverage. So, for $10,000, you can get yourself, be long or short the market, 20, $200,000 or more. So they'll give you enough leverage to hang yourself if you want. Now, leverages can be good if you know how to use it, if you're on the right side of the trade, but it can also wipe you out. Now, the takeaway from this is more so these extremes, and this is what the chart shows you. Keep in mind that although you can use leverage to short stocks, the vast majority of market participants are long and bullish. Bears are usually in the minority, especially more so in positioning than in rhetoric. So what it shows you here is you can see these peaks. The blue line here is the S&P 500. The red line's margin debt. So you can see the market topped here. These gray lines right here, these shaded areas, mark recessions. And as always the case, the market peaks in advance of a recession. Recessions are declared after the fact. In the market, I've always said looks out 6 to 9 months ahead. So here was the market top back in 2000, and you can see that we had, actually, I'm looking at the inverted. I should have started with the regular chart. The reason this chart, you're seeing margin interest, it actually peaked down here, but they inverted the chart on this one to kind of show you the divergence between the two. So when you see what really stands out, let me just try to clarify this. The sharp drop off at the end. Let me just flip back up here. There's the chart not inverted. Here's what I should have started with, make it a little more simple. Okay, so what stands out is you would expect during a bull market more and more people go on margin. Why? Well, you're making 10, 15, 12% a year in your 401k. You do it for a couple of years, or your brokerage account, I should say. And you say, well, why not? This is the stock market's it's an ATM. It's printing money. Sure, there's pullbacks along the way, but I'm making 12, 15% a year. Why not borrow money to double or triple or quadruple or more of those returns? And that's what people do, and they tend to do it. This is the fallacy of human nature. We've seen it every time at the end of any type of bull market, and you go back in history, everybody gets enthused and think this time it will be different. And so you can see the sharp ramp in margin borrowing right up to the top before the bear market started in a huge correction. And of course, margin bounces abate. Then the cycle repeats. We have a bull market, it's, growing gradually as it should, but then at the end you see this sharp thrust up. Again, people coming late to the game, saying, oh, this is so easy, let's leverage up, juice up my returns. And part of the reason these bear markets are so swift and compared to the rise leading up to it, is the unwinding of this the margin bubble. If you've traded on margin, you know what I'm talking about. If you're margined out to the gills, or close to it, and your stocks start going against you, you get a margin call. That means whether you want to or not, you have to sell those stocks. If you don't sell them, your broker will sell them for you. That is the unwinding of the margin trade. And it's what happens when we have margins peak and you get these corrections. And now you can see here we had, margins rising in line at record levels, mind you. We had a pretty, significant correction and sideways market for a couple of years, but then we had this final sharp thrust up in both stock prices and in margin debt. So as you can see, we're at historical highs, all-time highs by far in margin debt. And I'll say this too. Each cycle, as time goes on, since these are years apart, should be higher because as time goes on, there's more money in the financial system. There's more individuals, population in the world grows, more people are trading in the markets. And again, this big jump up had a lot to do with quantitative easing. Quantitative easing was money printing. The Fed printed money out of thin air, money that we didn't have. They added liquidity or dollars to the financial system. So therefore, that helped juice the stock market, and they blew what is now one of the biggest bubbles in history. And at some point, the unwinding of this bubble will come, and it will not be pretty because, like I said, fundamentals aside, if the stocks start dropping, it's a vicious cycle. Selling begets more selling, especially when everybody's maxed out on margin, as is the case. So there's another chart that just doesn't paint a pretty picture long term. And again, you can reference this in the trading room. They show it inverted there to kind of give you a visual of and they give you a couple other versions of the chart there. So, okay, let's say, Randy, you sold me on the longer term outlook of the, stock market not being so hot. Well, what do I do? Do I bury my head in the sand? Do I, load up on, triple short index shorts like SPXS and SQQQ, which short the Nasdaq 100 and the S&P 500? No, you can certainly short the broad markets if and when the evidence, and again, that this video is not I talked on that last night extensively. What I'm showing you now is a way to both not only survive but prosper in the next bear market, as well as outperform and do so. Here's what I'm trying to say: do so without taking excessive risk. There's a term in the markets and in financial markets and investing called alpha. I often use the term beta adjusted position sizes. When I put out a trade, I'll say, well, here's an extremely aggressive trade, very volatile, so let's do a beta adjusted position size of zero point 0.7, meaning 30% less than your normal position. That'll help account for the above average risk and returns. That's beta. Beta is sort of like volatility, if you will. Alpha is a term used in investing where you seek to outperform a certain benchmark. In this case, let's keep it simple. Most benchmarks, they'll use the S&P 500. So if the S&P 500 in a bull market were to climb 10% a year, and you had all your money in the SPY, well, you were alpha neutral. You were in the S&P 500, so you were going to go up and down in line with it. However, what we're looking at going forward, if I think and I do think at some point in the next few years we'll see the S&P and the Nasdaq 100 down 20, 30%, and quite likely more, um, then you can either buy one of those index shorts, the non-leveraged ones, and hold it, ride out the ups and downs, because I will tell you there are going to be some very profitable bear market rallies to trade, and I'll be looking forward to those. Or you can do what I've been doing recently, and I'm going to continue to make an effort to do, and that is diversify with both tactical asset allocation. What does that mean? Well, it means I'm going to look at different asset classes: stocks, bonds, commodities, gold. Tactical means I'm not just going to throw all my money, a quarter in gold, a quarter in commodities, a quarter in bonds, a quarter in stocks. Not at all. Tactical means at some points in time I might be long gold or I might be short gold. I might be long grains, yet short timber at the same time. I might be long certain stocks and short certain stocks, as I am now. And here's some examples. We'll just roll into that. And by doing that, you're diversifying your portfolio. You have you have a machine that's firing on all cylinders. Think of it like an eight-cylinder car engine. You have eight cylinders firing. If one goes out, the car is going to keep going. At least cars of yesteryear. I don't know, these new cars now with these computer systems are so fancy, but if you guys know mechanics, you know what I'm talking about. An old eight-cylinder will run even if you probably lost four of your cylinders. And that's what we're looking to do here. So, here's one of our recent trade ideas, XLP. Right now, the stock market, the Nasdaq 100 QQQs are down 0.5%. The S&P is almost flat, yet XLP is up. Why? Well, technical analysis told us that the charts confirmed an entry, and these are also defensive issue stocks. We're seeing money fly out of the tech stocks now. These hedge funds are and mutual funds and pension plans are forced to reduce their risk. That volatility trade, the short vol trade, has been broken. They cannot afford to sit tight, even though it's not the best time to sell. It would have been a lot better a few months ago. By mandate, they must reduce their risk exposure to the market, and they're selling what they own, as are individuals too. What I just talked about in that margin trade unwinding. What's chock full of margin? Not so much XLP, because XLP just corrected, fell in a few months. It dropped 13, almost 14%, one of its biggest drops in years. So I can pretty much assure you those that are maxed out on margin or have been didn't have XLP. You know what they had? They had Facebook, Apple, Microsoft, Amazon, etc. That's what's getting sold right now in forced margin selling. Now, what do? You have two choices when you're blowing out of positions or you're taking it out on your own accord. You can put it in cash or you can put it somewhere else. This is somewhere else. This is where institutions are going, or at least they have been lately. And we've also been long bonds, government bonds, TLT. The selling I thought was overdone, so we've been long treasury bonds. That's another place. It's not only a flight to safety asset when there's volatility in the markets. This is where institutions go. Pension funds, mutual funds, they need to put their money somewhere safe. Government bonds are relatively safe. You have interest rate risk, but I think the interest rate risk has been overly priced in and also baited. I think that and I feel confident, the more the markets drop, the more the chances of the Fed continuing on their planned rate hike that they've been talking about will diminish. So they'll back off that. In other words, if that happens, then that's a net plus for bonds. So there's two fundamental. There's a technical case and a fundamental case, I believe, to be made, and that's why we're long bonds. And again, bonds are a completely separate asset class than stocks. So by holding bonds and commodities, we're long sugar right now. It hasn't taken off yet, and I think it will soon. And if it doesn't, it's just one of many trades. That's the other thing. Don't put all your eggs in one basket. As much as I might love any one trade, I'm not going to put my whole portfolio or half my portfolio in it. Coffee, which is JO, I'm looking to get in soon. Yeah, but then on the flip side, I'm still watching, as I mentioned recently, to short wood, which is the global timber and forestry ETF. So, like I said, all commodities are not created equal. A couple others that we were recently long, and I'm considering adding back as long trade ideas again, are the grains, wheat. We were in here on a breakout here. I don't know where the target was, why it's not listed on this chart. Maybe I had on a 60-minute chart, or maybe it was an unofficial trade. But either way, wheat had a tremendous rip, broke out of this downtrend line here, back tested, and had a huge move up, and has now fallen back to support. You can see this is the same old support line I've had here for a long time. The trend indicator is still bullish, hanging on by a thread. We need to see it reverse here soon. And wheat's on standby for a possible trading op. And again, this is a way because these commodities have very little correlation with the markets. Yes, you see it down recently, but overall, plot a long-term chart of wheat against the S&P 500, and you'll see little to no correlation. On the grains, corn's looking good too. This one we hit our first target here, went on to that next resistance level, pulled back now to support. So you can see I'm starting to warm up once again. And this is why I have targets. And this is, again, the difference of active trading, swing or trend trading versus investing. Get in, get out, sidestep the corrections, and then get back in. And you enhance your gains. Even if corn's bottoming, sure, one could have bought it here when we entered the trade and hold it. and you'll probably be good. It probably will not take out those lows, but if you're an active trader, you can sell the rips and buy back in on the dips. If it's objective, trend indicator looks good, so there's another one we might look at. And finally, just to wrap it up, and again, even within the arena of stocks, which are one asset class, you have different types. Utilities, I recently mentioned looking good as a defensive issue. They've been moving up, and at very least holding up recently with the markets. Select stocks, Comcast still holding support. This is an official long trade idea on the site. Still looks good up to that first target and then more possibly. So again, it's about not just tactical asset allocation, but about security and sector selection and rotation. I think that'll be the key going forward. So I think we're going to see return back to yesteryear, back in the, pretty much pre 2005-ish, where everything there was just a tremendous trend towards index investing. But before then, the best performing funds out there were, due to good old-fashioned stock picking, market timing, and security selection. And with the indexing being overdone now, and the same things that led all those stocks up in the stock market to such heights, all the money flows into those index funds will work in reverse as money comes out of those funds. Those stocks will be met with forced selling, and so therefore it's going to create a lot of opportunities in certain stocks, and not be good so much for the others as well as the indexes. And then of course, just to wrap this up, uh, I talked about a lot of longs, but we've also done a lot of short trades, and this is, you can see these short trades, like Twitter closed out today. Overstock.com, we've shorted this stock twice, in late 20s, right at the end of the year, 2017, and again in 2018. We nailed the highs on it both times, and the lows got out right here. Here was the last trade. Shorted it here, covered it here, avoided that bounce, and that stock's still heading lower. Semis, as you guys know, it's another trade that we've had this year. Hit the first target. I mentioned a good bounce there. So point is, these are different sectors, and I'll make a focus, an effort to focus a lot on these sector ETFs, both long and shorts. But I'll always include a mix of stocks because as I just outlined, by looking at Twitter, Overstock, a lot of the trade ideas we've had on the site, the you can get a lot more bang for your buck if you pick the most bearish or bullish individual stocks within a bearish or bullish sector. It does cut both ways. If you're wrong, your losses can be a little higher, but I tend my preference normally is to pick individual stocks, but I understand that a lot of people don't have either the time, resources, or effort involved to manage a portfolio of a dozen or more individual stocks, which you really need to have at least that many to be minimally diversified. So therefore, I'll incorporate the sector ETFs, looking at commodities, various indexes, long and short. All right, that's it. So that's our plan going forward. And in the beginning of the video, I laid out some things that just don't say the evidence is not here yet. The primary trend is still bullish, but again, the evidence continues to build divergences, market breadth, other things like that, extremes in bullish sentiment that were hit in January, as well as the margin interest extremes. And from my experience, I didn't add that earlier. I should. From my experience, it takes usually months for those to play out. When you hit extremes in sentiment or positioning or anything else like that, whether it's bullish or bearish, those aren't exact timing indicators. It can often take several months, sometimes more, for those extreme readings to turn around and manifest in the form of a major trend reversal. So uh, we'll just like I said, we'll let the near term charts, the daily charts and 60-minute charts and everything like that be our guide as to what to get in, when to get in it, and you can decide whether you want to swing trade for the big moves down, like with this trade here, which we had the stop clip, but I may add that back. Go for the big move or micromanage these trades as each target is hit. And if you want to know my opinion as a target is being approached, if I think will bounce, because when I put these targets out there, that's usually months in advance of it being hit. I don't always reverse my trades off every target. There are levels when I look ahead where I think a reaction is very likely, but depending on how the intraday charts look and even the daily charts, if and when a trade gets there, that's where I'll decide whether to either book profits, possibly even reverse that trade from short to long or vice versa, or to just sit tight, ride out any reaction, and hold out for the big gains. And so, if you want my opinion on those, I try to convey it in when I do the updates. But you're welcome to drop me a line in the trading room. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.